Yeah, you're not allowed to wear a Marco Island cap when you're in Clearwater, though. That's not.
Well, I don't have a Clearwater cap, so this morning there was a lady that was all by herself on the beach, and she was out there on the beach towel, and she must have thrown a little morsel of something to these birds, to one bird probably. I mean, she had a ton, like 100 birds around her. Just, they would not leave her alone. And she was like, she was surrounded by this. And then anytime she moved, they all flew up and then flew back down.
Yeah. No, it's amazing that they call each other, yet they fight when the other ones show up. So there's something weird about that dynamic about a flock of seagulls, right?
Oh yeah. You remember that band, The Flock of Seagulls?
Absolutely. I almost have the flock of seagull haircut right now.
the pandemic flock of seagulls.
I have a haircut this afternoon, so we're good.
Oh, bummer. Now you're going to look like all Mr. Executive. I was kind of getting used to the, a little edgy. I like you better edgy, so.
Yeah. Sometimes I like to get scruffy, but I've been scruffy since March. So I haven't worn pants since March.
So today we're going to talk about, I don't like the term asymmetric leverage for most people because it actually sounds like something unattainable and not understandable. Yeah. But the topic is asymmetric leverage. How would you say, what is the best way to say asymmetric leverage in English?
Well, in English, it's stacking the deck in your favor. That's the way I call it. So you basically are trying to take only trades that give you the reward to risk ratio that is attractive, however you define attractive, right? So that's the way I would say. And so you're trying to only take those trades that will give you those attractive reward to risk ratio, which then will make it possible for you to achieve superior returns while not needing to be right all the time. I mean, that's the whole idea. Nobody's right all of the time. If somebody, says that, they're wrong. So you're not right all the time.
That's beautiful. That's perfect. Okay. Call over. Right. But that's really true. There was, have you ever heard of that economist back in the 1700s, late 1700s, early 1800s? His name was David Ricardo.
Mm-hmm.
So back in the day, him along with John Stuart Mills, Adam Smith, Robert Malthus, they were the creators of modern economic theory, and they came out of Britain. And, and of course, Keynesian came after them, and that, he kind of brought that to a different level and took it to another place. But he was a lot of people don't know this, but he was a successful stockbroker, and he made a ton of money. He worked on the London Exchange. And one of the things he said was he had if you talk to his friends would tell you that he always said, I have some cardinal rules. And my cardinal rules were never to refuse an option if you can get it, and to cut your losses, and to let your profits run. So he was the guy who coined that whole thing, and he made a ton of money doing that. And I think the idea of betting on the things that have a potential big payoff, but predefining how much you're going to risk to a small fraction of your potential payoff is one of the biggest secrets. Mm-hmm. And it sounds easy, but there's a few things that I think you have to do in order to make that happen. That you're cutting your losses and let your profits run. So, what would you? Let me just start off with this. So, if you look at the gold market, let's say you're bullish on gold right now.
Mm-hmm.
You could buy gold outright. There's a lot of ways you could buy gold, right? And if you think about it from a reward risk standpoint, it's like, how much can I make versus how much am I going to lose? You really can't control with certainty how much you're going to make, but there's like a ton of different ways where you can estimate that. So, but you can control how much you're going to lose, right? So I thought I would just punch up some numbers just to kind of have a base point for us to talk about, and just using gold as an example. I punched up some options on the IAU, which is the gold ETF, and said, hey, if we went to the longest dated options you can get, 2023, going out to 2023, and you were to buy some options right now, assuming you're bullish, I wanted to use this as an example. So what I did was I said, okay, here's where gold is right now. It's roughly about $18 or the gold ETF is roughly at $18 a share. So if you just do like a technical measured move, you say, okay, here's the base and here's where it could move. That number projects it out to being at about $38. So $10 higher than it is today. So you say, well, if it made a big move, I'm bullish on gold. I could be wrong, but if it could potentially go to up $10. That's a pretty big return. That sounds like, whoa, that's a big return. And it is just on the cash. But if you went out and you said, okay, well, here are some prices for some options if that happens, right? And I'm not saying you should buy options. I'm just using options as an example because when you buy an option, you know that you will never lose more than what you put in, right? So if you're risking 100% of what you put in, and then if it goes to 38, that's let's just call that the reward, right? What is your reward to risk ratio? Well, the risk is 1, right? Everything you put in. And if you just go through like 18, 20, 22, 24, the strike prices, right? If they go up, you're looking at reward risk ratios of 9 times, 8 times, 7 times. And if you're risking 1% of capital, then you would get an 8% rate of return on that one investment if you're right. And I think that's the concept. That's probably the easiest way to think about it. Maybe it doesn't sound easy to some people who don't understand options, but you can do that. In order for you to do that, you have to predefine your risk. So maybe let's talk a little bit about predefining risk. Maybe if you have any thoughts about that, how, before, like, just to, we always define how much we're going to risk before we get in, right?
Yeah, and that's correct. That's what I was going to build on, is what you said is when you get into a trade, especially in the case of, let's talk about a long only stock investment. The only thing you really know is how much you're willing to risk on that trade. You don't know how high it's going to go. You hope for it and you've done your homework and you think this is what it's worth. This is what the upside potential is. But going into it, the only thing you can predetermine is how much of your capital you're willing to earn to bet on that turn. Use the casino example, right? You just, how much are you willing to put on the table on that spin of the wheel, right? So we're doing that. And how you use that information is basically, let's say we're willing to risk 1% of our money on that particular roll, then you can determine how much based on the risk of that investment, and there's many ways of measuring that, right? We have statistical measure like standard deviation, you have drawdown, you can use technical analysis to determine maybe those levels of support and resistance. You could also use fundamental analysis to determine what is the worst case scenario for the value of that security. And then if you divide your capital divided by that amount of risk, right? If it's a price per share, for example, let's say your $18 IAU, I'm looking at it right now, and I think that the worst case scenario is $15, right? So that gives me a $3 risk. Then I can take, let's say I'm risking $1,000 divided by 3. That tells me how many shares I should be buying, so that my capital at risk should the worst case scenario happen. And believe me, if you've been doing this long enough, you will wake up one morning at the worst case scenario. It always happens. Right. It happens to every investors, and therefore you should not. This is not an emotional decision. It becomes a automatic discipline reaction. You said, okay, this is my worst case scenario. I've hit my uncle point from a risk standpoint. I should just take my loss on this one and live to see another day. And that's the whole idea, right? You still have capital to put into the next idea, right? And if you do that, for example, if you maintain, again, you talked about the upside, you had a very high ratio, but let's say you had that 8 times your money on the upside in the case of an option. Well, you can do the math, right? If you risk 1% on every trade and you can make 8% if one of them go right, then you can be wrong several times in a row and still make money to be right one time, right? Now, of course, in real world, at least in stocks, we don't have an 8-to-1 ratio usually. So
anyway, let's get back to our.
So if you piggyback, so that's kind of the way I would bring it back to the concept of predefining your risk on a trade, and maybe how mechanically you could make sure that you are sizing those opportunities according to their risk and reward ratio, and therefore you can determine what is your success rate. What does your batting average need to be for you to make money, right? If you know that you're going to try to maintain a 3-to-1 ratio, that you can mathematically measure how many times you have to be right out of 100 or 10 to still make money, and that's maybe the beauty of it, right? There's a lot of uncertainty in a lot of things, but those are the things that we can try to predetermine. So
predefining risk. So you went through the whole calculation. That's awesome. I mean, basically without actually really, very simply, but I think there's defining risk. If we just go through defining risk, there's more than one way to do it. So the simple example is an option where it goes to 0, right? Another way that you mentioned was you make some estimate about how far it could go down, and it'd be reasonable to stay within that if you're going to be right. And so you could do it like on a probability basis. Like, so if with a standard normal distribution, there's a 95% chance over a 21-day time horizon that the stock should not go below a certain amount. And if it does, then you're probably wrong on the trend. Then that distance can be used as your loss potential, and then you position size to risk a certain amount on that. And you could take into consideration correlation, all of that. So that would be kind of a different way of predefining the risk. Another way of predefining the risk would be more fundamental, saying at the worst case scenario, fundamentally fair value should be a certain number, and if things don't work out. And I think probably most of Wall Street uses that way of thinking. Like if the value is my estimate of fair value is $50 a share, but then if the company doesn't do well and this and that and the other happens, then the share price is really only worth 30. Then they size on that. Now, if you do that, the problem with that is the markets don't adhere to valuation numbers. So that's, I mean, in the long run, you could make an argument that it could if you had perfect knowledge. But I do think it's valuable because what's interesting is that the stocks that have the most variability in their fundamentals tend to have the most variability in their price as well, which is very interesting. And also there's quite a bit of research that shows that the volatility of the instrument is a pretty good estimate of the future the current volatility is a pretty good estimate of the future volatility on a relative basis. So in fact, volatility estimates are more stable than return estimates, and they're generally more stable than correlation estimates. So if you just went with the naive models. So that's a very interesting observation. There's a lot of statisticians have kind of talked about that. But I think the point that I wanted to kind of talk about today was the fact that if you have a diversified basket of asymmetric payoffs, like what we're talking about here, the risk is you're only going to risk a fraction of what you could make, then like you said, you can be wrong a lot and you could still make money. And then also when you do hit it right, then you can make really good money. And I think that's really, really important because you have to get in the game. You're never going to be a good investor unless you can think this way, in my mind. Because one of the problems is that like back in like when I first got into business, Wall Street would say, "We don't gamble." And I agree with that. We're not gamblers because the odds are actually stacked in our favor. But the way of thinking of a gambler is important. It's not that you're gambling. It's that you are thinking in terms of probabilities. So let's talk about the other side of the equation. So ask you a question on that, because the other side of the equation is how much you could make. So we talked about predefining risk, and we also talked about how much you can make can actually vary. But and it's also the least predictable. But it's really important to know your odds, right? I mean, it's really important to know what your odds are as something being successful. So can you talk a little bit about some of the ways that you can know your odds of making money on something, on an investment?
Yeah. So just like risk, I think there's various methods of approaching that that problem. The first one, and I'll start with that, would be, of course, having a fundamental opinion of value on a stock, which is going through the painstaking process of valuing, running a DCF, relative valuation, however you name it, and said, okay, this stock is worth, based on my expectations of the company's future cash flows, this is what it's worth, and it's trading at X. And then from that, you're able to determine your upside from the current market prices, right? And that's pretty much Wall Street, or the way the traditional investment research industry is working. So you have a target price that gives us an idea of what something is worth, and that from there, it doesn't, again, we just define risk. It doesn't tell you the odds, right? So you don't have to make your decision as to does the stock, based on this target price, give you the odds that you are that are favorable for you to take that trades, right? So that's of course the thing you want to do if you are really taking a fundamental view and not willing to do all that work. Otherwise, the other one is using those more I would say technical quantitative measures of projecting movement upward, right? Like we know, fundamentals assume that investors are rational all of the time, and basically that the market, in the long run, should reflect the intrinsic value of a stock, which we know is not knowable, and at least is a moving target. And we know that stocks go well beyond their fair value in many instances, and that's where maybe that way of thinking could be flawed, right? Because if you sell at your target price, the market doesn't necessarily want to stop there, right? So you might actually run way up in valuation, and you'd be losing on profits. So we said one of the biggest mistake I think that people make, and it's been also documented many times, is we tend to sell our winners too soon and hang on to our losers too long, right? This is exactly what it is. So, so
that falls into David Ricardo's.
Exactly. So it's good to have an idea of what something is worth, so you know that you're getting into that region or that area of something being extended, right? So it doesn't mean sell. It just says, okay, keep maybe a short leash on this thing, right? It's running, it's strong right now, but maybe the rationale, like the fundamental rationale behind that particular stock I'm referring to here, is a little, flighty, right? So so that would be one way to do things, and when you do that as well, we go back to risk. Your risk increases, right? I mean, you have now profit on a position, right? So you have profit on a position. We don't want to lose that profit, so you want to protect some of that profits. So there's a lot of reasons in a portfolio management context that you would want to protect some of that profit, so that a stock that is a winner does not become a loser should something go wrong, right? So I think there might be a different way of managing risk once something goes in your favor versus a fresh new ideas that where you know what your risk is, and that's pretty much your backstop, right? Versus when you go up. So you want to maybe I'll turn it over to you, and maybe since I introduced the whole concept of kind of trailing, maybe you want to.
Yeah, I think that's a different part of the equation, but it is important. Yeah, so there's the initial risk, how much you initially, the risk that you are putting, how much are you going to risk of your core capital before, when you first take a position on, and then there's that issue of how much open risk are you going to have after, there's been progress made with the investment, and that does affect your overall volatility of your portfolio, which is a little bit of a, I guess you have to predefine that as well. If you're going to make your decisions based upon the actual observable portfolio numbers. So a lot of investors don't make decisions based on observable portfolio performance. They make those decisions based on a fundamental factor and just assume that part of their equation is right and just let the chips fall where they may. So I think that's a point of difference, I think, in how we do something versus how we manage money compared to much of Wall Street. You had mentioned an interesting analogy of, if you see an iceberg and you're, driving the big cruise ship, you see an iceberg, you better turn, right? Or are we just going to run right into it? So I thought that was brilliant. I'm sure that's been said a million times, but I guess I'd never heard it. But yeah, we want to definitely look at risk from different perspectives rather than just only initial risk. But I think there's a few points. One point that I was going to kind of build on was that we talked about, you want to diversify your investments so that the fundamental drivers are different, and the price action correlations maybe hopefully are different too, not just the fundamental drivers, so that you can have as much as you can non-diversified, non-correlated bets. But the other thing is, the big thing with stocks in particular is the high volatility sell-offs, and how it doesn't matter how much you diversify fundamental drivers. When the volatility increases, we have a higher probability. So the last question we talked about was, what are some of the ways to think about how much you're going to make, estimating how much you're going to make, because this is all about asymmetric reward risk. Mm-hmm. Well, you had mentioned fundamental and then technical measures as well. I think what's interesting about that is that doing simulations is another thing. Running simulations and saying, okay, and I guess that ties into your quantitative. What is the base rate that you're finding in bull markets, bear markets? Just observing it. What is the percentage of time that you're going to do well with a certain technique versus losing money? And that's not a bad starting point, I think. You can have a difference, though, between your statistical odds of some kind of quantitative method versus using qualitative. And we've noticed that ourselves, our actual hit rates in the proprietary account are much higher than the quantitative trend following type hit rates. So there's, you can use other things other than quant that will help improve your percentage of the time that you're right. So I think the other thing I was going to bring up was factor testing. Another thing we look at is factor testing, and there's some ways that the factor testing will help us understand whether or not there's a higher probability that a certain type of investment or an investment with certain characteristics has a higher probability of doing well. So, and you mentioned at the very outset that this is about stacking the odds in your favor. So that's the first part. Second part about this whole thing is making sure that you're risking a small fraction of what you could make. And then, so we have to look at all of those, minimizing the risk, stacking the odds in your favor by looking at what can help us have a higher probability of having a good investment. And so it's really interesting when you think about it from a mathematical standpoint. Most people don't like to think about it from that standpoint. But in the real world, it basically it is that. I mean, we can talk about theory, but I mean, we're trying to get our theory to be in line with the observable facts.
Yeah, and that's a good. I mean, that's a good point there because when we think about quantitative analysis, is what we have is basically said, okay, the stocks with these characteristics here, and we happen to have our own buckets, right? That define certain types of stocks tend to have these excursion, right? Either negative or positive, right? So that gives us a sense for, well, don't go outside of these bends. You probably have a very low probability of reaching those, right? So that gives you that anchors your expectations from a risk and return standpoint, right? From that, then as you mentioned, if you believe that qualitative or analytical work can supplement that and actually improve your odds, as I think we're starting to have quantitative evidence that it might be possible, then you're in good shape, right? That gives you more confidence into your bets, right?
And the only way to know that is to actually do it, and then to observe it versus the models, the quant models. Mm-hmm. So the more you do it, and then you have a difference in the more you do qualitative type analytics that are demonstrating that they have better statistics than a pure quant model, the more you have confidence that is something that should be instituted in what you do. So, but to be able to, there are those that say I want to be 100% quant, and those that say I want to be 100% qualitative, and I think we're a little bit of a hybrid of those two.
I think we are, and I hesitate to bring up another topic, but it's hard not to, because I believe what we do is all very well. I know it all fits together, but it's the idea of the entry point, right? And I think if you think about an investment, when you decide to enter that investment, has a lot to do with your risk. Actually, like you can actually additionally stack the odds in your favor by entering a stock that you believe, again, based on quantitative evidence in our case, has more odds of moving in your favor, right? And right there is an additional layer of maybe refinement in your trading, right? So it's one thing to say, okay, you've done all your homework. Let's say I'm a fundamental guy and I can do it as much as the next guy. I think this thing is undervalued. Should I just go and buy it today, whatever price that is? Some people would do that and might be willing to sit through the pain of owning some of those undervalued stocks. We tend to believe that we can actually refine, have a list of companies that we find attractive for whatever reason, whether it's on the growth or on the value or whatever characteristic we're looking for, but then wait for the proper time to enter that trade. And then this should, again, improve your results, right? Your hit rate. So that's another level of risk management, which sounds like
yeah. Oh, for sure. When you enter has a lot to do with your risk. There's times when, well, if you just observe the markets, in the equity market in particular, you tend to have periods of low volatility and lower volume prior to big moves, not the other way around. In fact, a good friend of mine, Jason Meshnick, who's also a colleague, him and I worked on a paper that we did on volume. And what we found was that lower volume actually leads to better returns, not higher volume. So when you have contraction in volume with tighter, lower volatility, you have a higher probability in the next month, based on the work we did. And we did it on, I believe we did it on four different market environments, bull and bear environments. So that's important to know. So those are things that I think can help stack the odds in your favor. In terms of entry, when you decide, I think there's a lot of companies out there right now that probably you can make an argument that value-wise they look more attractive than others. I mean, in particular, last week we talked about international stocks being in that realm. Many of those companies technically have not really kind of hit the point where you would want to buy them. So, but there's a setup there. So there is a concept in the technical world of setup and then entry. And I'm a big believer in that. Rather than just buying the setup, you fine tune. Once the conditions are ripe, then you look for that catalyst for the actual entry. So asymmetric leverage, a very cool option, very cool concept. Hopefully somebody got some ideas out of this. And anything else you want to say, JP?
No, this was good, and I think it set us up for maybe a follow up on some of these great ideas. I know we toyed with the idea of looking at some basing stocks and what that means. Maybe we can visit that next time. So yeah, this is another piece of the
yeah, maybe we do that next time because we're kind of running out of time.
Yep.
But that sounds really good, JP. Good talking to you as always.
Same here. Have a great week.
All right, you too.